Hi traders, welcome to this edition of Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is generally a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. So whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll first check out how markets are trading currently. We'll then just check out, well, the latest tariff headlines, basically, and a few thoughts on that. Before then, diving into the second quarter earnings season, we'll just have a few thoughts on that with all the big banks, all the big US investment banks reporting this week, really kicking off the season in earnest. And yeah, we'll just have some thoughts on that and a couple of charts as well of interest. Before then, looking at some of the technicals, with obviously the US indices, the S&P 500 and the NASDAQ making record highs last week. So we just check out the Dow chart as well on that. Before then, looking at a few things from last week, mainly some central bank meetings out of the RBA, actually out of Australia then, and out of New Zealand, the RBNZ. A surprise from the RBA, so we'll look at that and the Aussie dollar, as well as the Kiwi dollar when looking at the RBNZ. Before then, looking at this week's main events, focus on US inflation data, of course, that's out on Tuesday. We have retail sales on Thursday. We have a bunch of UK data as well, the inflation data as well as jobs, and we have the Aussie jobs data as well. So we'll look at all of those. We'll look at cables, so that's sterling against the dollar, Aussie dollar as well, as I mentioned, and then the DXY, so the dollar index chart as well. Okay, here's just a wrap of everything that we hope to get through, as I say, in the next 30 minutes or so. Please do as well, I should say, please do ask any questions along the way in the box. We'll be more than happy to answer, if we can, of course, anything that you're looking at or anything that we're talking about as well. Then please do ask questions. Always say anything big or small is all good, and we'll try and look at those as well. Firstly, then headlines this morning, Monday, kicking off the week. Even President Trump, of course, sent trade letters to the EU and Mexico over the weekend, announcing 30% tariffs from August the 1st. That's separate from sectoral tariffs. The EU is then planning to, I think, step up engagement with other nations impacted by US President Trump's tariffs, according to Bloomberg sources. Interestingly, APEC stocks, Asian that is stocks, were mostly positive with, well, of course, some cautiousness seen following those tariff letters, but the region really reflecting on mixed Chinese trade data. European equities are marginally lower, Euro Stoxx 50 down around 0.5%, Euro Stoxx 600 down around 0.2%, I think, when I last looked. And that comes actually after losses of 1% on Friday in Euro Stoxx 50. US futures there marginally in the red. So not liking too much this sort of noise out of the White House, of course. The dollar index, that's marginally softer after opening better bid, actually, and euro dollar is slightly firmer now, but pretty much unchanged, actually, looking at it now, despite, of course, tariffs, Trump's tariff announcement and other majors really quite contained. Looking ahead, we do potentially get Trump comments around Russia, and we'll talk about those briefly shortly. But regarding the tariffs, you have to say it's seemingly another negotiating tactic again from Washington. Markets really assuming that better deals will get agreed by the August 1st deadline. You can only assume that, right, with this price action being fairly benign, pretty quiet out there, and not really reacting to those sort of quite big headlines. That means really at the moment, markets assuming, again, we shouldn't see a repeat of the early April market shock, really, in that response to those April Liberation Day tariffs. As I said, though, more interesting potentially near term are these fresh sanctions on Russia by Trump. It seems he's now really losing patience with President Putin. What that means then, potentially there could be secondary sanctions on those countries buying Russian oil, and I think tariffs of 500% have been mooted. So just watch out for headlines on that, because potentially then we could get a bump in oil prices, and that, looking at the macro picture, would be good news for, say, the energy independent US, of course, and potentially help the dollar. And it could be negative then for those big energy importers in Europe and Asia, so possibly slightly negative for the euro and also the Japanese yen. Obviously, things are changing all the time, and it is interesting. We said last week, I think, about, or especially in our daily reports that we write about, the EU potentially agreeing a deal over the weekend. So, yes, you can just see how things are volatile, how things change rapidly. So just watch out for those headlines, of course, through the day. Otherwise, it is earnings season, and a couple of charts for you here. Q2 earnings season, yeah, begins in earnest really this week. We've already had around 40 S&P 500 firms release already, and a little bit of guidance from some of those, depending on the firm. Just remember that we think it's interesting. A few points here. Dozens of US companies actually suspended guidance during the last earnings season because of uncertainty surrounding the impact of US trade policies. So really a key uncertainty now will be how many, if any, how many will continue to suspend guidance, or indeed how much faith markets may have in whatever guidance, of course, is provided amid still this elevated uncertainty. That's one thing to consider. Also, of course, key will be results relative to expectations. And you can see on these charts, firstly, on the left-hand side, really, that those expectations, those estimates here have been lowered over time. That you can see from sort of January, start of this year, downwards. So downward estimation of EPS for this quarter. And that is especially the case on a sectoral level. You can see for energy and also consumer discretionary stocks have taken a brunt of those lower expectations. So again, keep an eye on that. Also, I think, or we think, profit margins potentially will be interesting. One theory doing the rounds is basically that tariffs may not kind of initially pass through to inflation if relatively high profit margins are allowed to erode, at least for a time, of course. So that's something to watch, and whether they are impacted going forward. For this week, then, as I've mentioned, we get the big US investment banks. So we get JP Morgan Chase, Bank of New York, Mellon, Citigroup, Bank of America, Wells Fargo, State Street, Goldman Sachs, Morgan Stanley, and BlackRock as well. They all report this week, I think. And we do get other companies like GE, United Airlines, and Amex as well, among the key names. And then also, just for your guide, on Thursday, I think after the US close, we get Netflix, a market darling, really, because it's been performing so well post results as well. So just watch out for that. And we get as well, just for your guide, a classic bellwether stock, which is 3M. They report on Friday. Again, I should note, of course, overall S&P 500 earnings growth expected to be just shy of 5%, 4.8%, I think, year on year in Q2. That would be the 8th consecutive quarter of growth, but if realized, would be well below Q1's near 14% growth, and it would actually be the slowest quarterly growth rate since the tail end of 2023. Yeah, so that's really earnings season. Very quick summary of some things that we'll be looking out for. Should also say that earnings are seen declining from those first 3 months of the year, but as we've seen, a plunge in the US dollar will potentially offset some of that damage. The dollar, of course, is down about 10% year to date, after, of course, enduring its worst first half since 1973. And just a chart here, just showing you that bar chart, the first half, and you could just see hasn't really been that bad since, 1973, in that era of free floating exchange rates. So potentially that will help offset possibly some of the tariff noise if we do get some impact on that as well. Just for your guide as well, and we will be getting into these, but the Mag 7 names next Wednesday, 23rd, just checking, 23rd of July, after the US close, Google and Tesla report. And then the following Wednesday, the 30th, Meta and Microsoft report after the US closing bell. And then that following day, 31st of July, Thursday, Amazon and Apple report after the US close. Those names obviously very important for markets going forward. Nvidia, just for your guide, finally, they report actually late August, I think 27th of August. We will actually be doing a webinar on, let me just check the date, on the 29th of July with the Australian analyst, Hebe Chen, and she will be answering lots of questions from me about what are the expectations. So that's a provisional date, but do watch out for that as well around earnings season, where we would, Hebe will be reviewing some of the results already out and then previewing for sure those ones incoming, including Meta, Microsoft, Amazon, and Apple. In the following days, actually in the 48 hours after the webinar. Okay, just looking at stocks, US stocks otherwise. I'll just pull up a chart first of all, which is the S&P 500 that you can see here. I mean, last week, as I mentioned, all-time highs were seen in several markets, S&P 500 and the NASDAQ 100. Really, risk appetite remains solid despite all this trade uncertainty, which is, of course, interesting. Whether there is too much complacency in the markets, and you have had some big hitters, market watchers, Jamie Dimon, head of JP Morgan Chase, just inferring there is too much complacency and we really should be careful of what may happen on August the 1st or going forward after that deadline. But at the moment, markets really ignoring that and making fresh record highs, as we said. Also, record highs being seen, actually, all-time highs in the DAX, the German index, boosted by, well, they were boosted by US-EU trade deal hopes. Let's just check the DAX now. And it's off 1%, which is inevitable after the weekend news, but still holding just above 24,000. Let's pull up that chart. Actually, you can just see that all-time high made on Thursday of last week at 24,639, and we just rolled over. Friday was a down day, and today, of course, down another percent. That's a DAX actually, which I wasn't going to look at, but here we go. Interesting chart because we've come off those record highs, but the blue line there is actually the 50-day moving average. You can just see it held support or acted as support previously in June. So that's at 23,825. And then I haven't actually extended my Fibonacci. I haven't looked at the chart for a while, but the previous high from March and mid-March of this year was at 23,476. That could be a previous line of support. And then you've got that high as well from June at 24,479. I really should probably move this up to the recent high then, which would be around there, I believe. Let's just double check, 639, 642, just around there. Let's just do this for good order. Just to be more exact, so you can just see, interestingly, that first Fibonacci, which would probably be the other way around. So it would be the 23.6, just ignore that, but the same level would apply. So 23,323 is potential support below that 50-day moving average, and that tallies with those highs from March. So fairly decent level of support that in the DAX. But back to the US, sorry about that diversion. But yeah, as well, the FTSE 100, that also hit fresh record highs, aided by gains for global miners. As for US stocks, well, Friday saw them in the red, actually, well off their intraday lows, as then attention turned to Trump, of course, and this tariff letters. Well, the inflationary fear aspect of higher tariffs pressured treasuries as well. You can just see that high then from Thursday again, 6,290. We've got that high, and interestingly, we just sort of closed with a sort of very narrow range doji on Friday, just a touch lower. For the Nasdaq, similar chart, made the high on Thursday at 22,907, and we're just below that now. Interesting, the Dow obviously lagging those two. Very little tech in the Dow, certainly, and you can just see the all-time high just above 45,000. Haven't yet broken through that. We're just sort of consolidating, looks like bullish consolidation really, as we're holding sort of 44,000 just above that. If we break down then through that, then that will roll over. But at the moment, bullish consolidation before potentially a move higher. You've got the black line, which is a 200-day moving average. That's a 42,717. And then the blue line potentially just crossing above that 200-day, which would be possibly bullish, a golden cross. Not too sure about those indicators generally, but people like to cite them and trade them, obviously, with other things they're looking at. But you can just see, yeah, we're just bearish, sort of slightly bearish momentum pointing down in the RSI. But then, yeah, as I say, that 50-day potentially crossing up above 200-day, and something to watch out for possibly there as well. That can sometimes be lagging, so we may have seen that high, but we'll be watching that closely. Okay, let's move on now to those central bank meetings briefly from last week. So firstly, the RBA meeting. If I just pull up the Aussie dollar chart. Which is here. So yeah, as I said at the top of the webinar, they surprised. They kept the rate unchanged at 3.85%. Another cut to 3.6%, so a 25 basis point cut was widely expected. So quite a surprise from the RBA. They basically said, the bank said, inflation broadly moved according to the May forecast, but nevertheless spotted some upside surprises at the margin, I think they said. So with rates now 50 basis points lower than a few months ago, and wider economic conditions evolving broadly as expected, then basically the bank believes it can wait for a little bit more information, and therefore confirmation that, of course, inflation is sustainably returning to its kind of 2.5% target between the 2 and 3% bands. Of course, they mentioned the outlook remains uncertain, especially regarding trade, but the RBA does see private domestic demand recovering and household incomes picking up. And that is in part thanks to the still tight labour market. We'll run through those details of the fresh data coming up later on. Aussie bond markets, they reacted sharply, of course. Swap rates, they jumped over 10 basis points at the front end of the curve, actually, and that did allow Aussie dollar to recover most of the losses incurred the day before, and thereby sort of preserving this sloping upward trend channel that you can see slightly. Yeah, so interesting reaction from the RBA, not cutting as expected. You can just see Monday and Tuesday's result here. So Tuesday we bounced off the 50-day moving average. That's at 64.86, the blue line. Yes, it looked as though potentially then we were going to break higher finally through this major fib level, 65.49. But we just pulled back again. So that'll be pretty decent support, you'd like to think. But there is quite decent resistance around that sort of just below that 66 level. Just sort of containing the upside so far. So initial support 65.49, and then you've got that 64.86 50-day moving average. Otherwise, top side, if we do get a break of 66, then potentially we're looking at these highs here from November at sort of 66.80, 66.87, just before 67, and then that fib level. Okay, that was the RBA. We also had the RBNZ. They did what was expected, so they did keep rates unchanged. That was expected, as I say, at 3.25%, expected by both markets and analysts. The case for another rate cut that was considered, mainly over near-term growth momentum and the risk of prolonged weakness in economic activity, leading to possible downward pressure on medium-term inflation. In the end, though, the benefits are waiting until August, really, in light of near-term inflation risks and swings, of course, in global trade. Those outweighed that then. Inflation, that's expected to rise further from the 2.5% in Q1 towards the top of the target band that the RBNZ have, which is 1 to 3%. But then it's expected to return to around 2% by early of next year on spare productive capacity. That basically also allows the bank to observe developments, of course, in tariffs in the global economy, and then also whether domestic economic weakness persists. Money markets in New Zealand, they are discounting still a rate cut for next month, around a 2 in 3 chance, around a 66% chance, 60% chance of a rate cut in August. So odds on there pretty much. And you could just see the Kiwi dollar similar, looking to break to the top side, but then falling over. But then the blue line is capping the downside. So that is acting as support again. That's the 50-day moving average. Excuse me. That's a 59.91. You can see there. Recent high just above 61, 61.20, and then below, if we do lose that 50-day moving average, you've got the halfway point of this move down being at 59.31, and then top side, if we break 61 conclusively, then potentially 61.86 is what bulls are looking at. Okay, that is the Kiwi dollar. Let's move on now to this week's main events. Just let me bring up a couple of charts then. So yeah, this week's main events: US inflation data, UK inflation data, UK jobs and Aussie jobs. Firstly, US CPI data. Expectations are for the June headline to rise from 0.1% to 0.3% month on month. You can see that in the chart here. Year on year would be 2.6%. The core, that's seen at 0.3% month on month and 2.9% year on year. Surveys, they point to rising prices, but then you have seasonal adjustment factors for core CPI have been low in June, and gasoline and food prices have been muted. Of course, the big question is basically, will tariffs finally impact these consumer prices? Ultimately, probably the effects of tariffs should finally start to show up, although the effects probably will be more sizable in the July to September data than this June data. Still, the data has the potential to start probably or possibly removing some of the easing that we see priced in for the 17th of September Fed meeting. There's around 17 basis points priced in, so that's around a 68% chance or so of a 25 basis point rate cut in the September meeting. This is so any removal of that, of course, would be slightly positive for the dollar. There's around 52 basis points, I think, a bit higher than that for 2025. It is interesting. Most Fed officials have taken this cautious approach, of course, on the outlook for rates, given expectations that, of course, consumer prices are expected to rise towards the end of the year due to tariffs. We have had a couple, Bowman and Waller, of course, Trump appointees. Basically, they've suggested that tariff-induced price rises might be a one-off, and then therefore may allow officials to look at rate cuts as soon as the July meeting. Money markets don't think that is an option. I think there's around a 6% chance only of a 25 basis point cut at the July meeting. That's right at the end of July, just to note. But that's only if inflation pressures remain contained. So interesting, yeah, this report, of course, with this tariff issue, of course, and whether we finally get an uptick or not. And then potentially that pricing out of some of that easing that we've seen in September, at least. Also interesting, probably with all this noise around Chair Powell, Fed Chair Powell, that is, and obviously resignation or leaving his post early, which seems very, very unlikely. Market's really not looking at that, but there is a lot of speculation on social media. Really, yeah, highly unlikely and would cause major volatility in the dollar for sure, in treasury markets for sure, if that was to happen. But yeah, there are potentially fairly decent replacements in the pipeline, but they would, of course, be more dovish, and then we would see more pricing in of rate cuts, certainly for next year. And we've seen that already when Chair Powell officially leaves his post, I think it is in May, and we've seen a pricing blip, if you like, of more rate cuts after that date in any event. We do also get US retail sales, I should say, on Thursday. That CPI data is out on Tuesday in the US. Retail sales consensus forecast sales to be unchanged actually in June, and then the ex-autos measure is expected to rise 0.3% from the prior negative 0.3%. Lower vehicle sales and little change in seasonally adjusted gasoline prices may actually weigh on the numbers. If we look at, here is the US CPI data, just for your guide. And if we just look at the dollar chart then, let me just pull up this, which you can see here. I've left in this bear channel, which is a series of lower lows, lower highs. You can see long-term bear channel from that high really in February. And we're just sort of breaking up through that now. We have done it briefly in the past, but interesting whether we have formed a base here. You've got that 50-day moving average again, the blue line, which has acted as resistance. That's at 98.82, so 100 basis points, 100 pips higher than where we are at the moment. So just watch that. I've got this long-term dotted line in here, and if I pull it back on the monthly, you can see it goes down to this low in May 2011, then capped the downside in 2021, and you can just see, if I bring it back to the daily, we capped that again, touched that again at the start of this month. So interesting whether that works again or not. We shall see, but that would be obviously tallies with that low from the start of July, that low being at 96.7. Okay, just moving on now to UK data briefly. Just going to pull up the cable chart. So this is sterling against the dollar that you can see here. Just expand that a bit. Yeah, firstly, we have, well, UK CPI data out on Wednesday. Analysts forecast the headline rising 0.1 to 3.5%. Core unchanged, also at 3.5% actually. Services inflation, that's expected to come in soft again, though base effects in core goods could counteract that cooling. From a policy perspective, it's interesting, the release probably underscoring really this sort of balancing act that we have for, that faces, the MPC faces really, the Bank of England faces, tough balancing act between growth appearing to be slowing, but then the labour market is loosening, but then inflation is stubborn and set to remain so, even with sort of services inflation slowly coming down. For pricing for the Bank of England, as it stands, I think there's quite a high chance of a 25 basis point rate cut in August, around 75%, I think. And there is around above 50 basis points of loosening in total seen by year end. That's CPI then. We'll also get jobs data, important that is for wage growth numbers. Unemployment, well, that's forecast to remain at 4.6. We obviously have reliability issues with that data, well known there. More important, as I say, wage growth, ex bonuses, that's expected to cool to 5.3 from 5.6%. Base effects from lower wage settlements should be helpful in bringing down the data. And interesting again from a policy perspective, the likes of Governor Bailey and Ramsden, they've noted the softening in the labour market. But we haven't had that much comms really from the MPC to brace markets for an increase in the pace of rate cuts, which comes, well, from their current sort of pace, which is every other meeting. Should note as well, the impact of the release will need to be taken in the context, of course, of the inflation data out the day before. But wage growth is an important number for the MPC, so just watch out for that the day following on Thursday. Cable, you can just see rolling over slightly from that multi-year high, start of this month at 137.88. Blue line again, the 50-day moving average working well as support. Just watch that, whether it works again. That's at 134.96. So we're just trading below that. Otherwise, I should move now this fib level up to that high, which is around there. So just pull back, and you can just see that interesting, that swing high, cycle high from September. That's at 134.34. That could act as support. And then you've got more or less the first Fibonacci level from this move lower, which is around 133.86. Okay, that is cable and the UK data. Otherwise, we do have Aussie jobs data just briefly. That is out on Thursday. And that June data comes after the May's surprise, actually 2,500 drop in employment. Although if you look into detail, I think mostly part-time jobs that. And that comes again after the sharp, big April gain of 87,000 plus jobs added. Market forecast, I think, is around for a reading for June for plus 20,000, with the underlying 3-month average jobs growth holding steady around 2.3%. And that matches levels from 2024 actually, and signals really ongoing labour market resilience in Australia. For your guide, the participation rate, that dipped in May, but is forecast to edge a touch higher in June, and then that would support the view that unemployment will hold probably at 4.1% for a 5th consecutive month. Ultimately, as I said, still robust, still resilient, the jobs market, despite, of course, sort of monthly volatility, and that will be foremost in the RBA's mind. They may be more focused, though, on inflation data, which comes out later on in the month. Okay, I think we'll wrap it up there. Please do follow us on social media, a number of channels, and we also post a daily commentary after the US close every day on the website. That looks at the dollar, US stocks, the day ahead, and also a chart of the day. Don't see any questions, so really do appreciate you being on the call. Always appreciate that and taking the time out to listen for half an hour or so. Watch out there, lots of headlines going on, of course, with Trump and tariffs, as well as, of course, that CPI data as well from the US, from the UK. We also get Japan CPI data, no forecast for that, but that comes out on Friday, I should say. Yeah, follow us on social media if you can, and really appreciate you being on the call, and we look forward to speaking to you same time next week.